Welcome back to the Financial Literacy Project, a free educational video series presented by the American Bar Association Tort Trial and Insurance Practice Section and Thomson Reuters. Please remember as you proceed through these modules that the information provided is for educational and informational purposes only. That means that the information should not be considered legal, tax, financial, investment, or other type of advice for a specific situation, and does not create a client relationship between you and any of the attorneys or the financial professionals presenting the information. In the first segment, we learned about the importance of banking. In this next segment, we'll learn about issues involving credit. So let's hear from Amy, our next presenter.
Hi, I'm Amy Moffett, Client Acquisition Specialist with First Horizon Bank. I am pleased to talk to you today about credit, share some tips to boost your credit score, and some brief thoughts on budgeting and investing. Credit is complex and is an integral part of your financial journey. Achieving a high credit score is a major step to achieving long-term financial wellness. A credit score is a statistical method to predict the likelihood of an individual paying back the money he or she has borrowed. Lenders use your score to determine your creditworthiness, and it impacts the lender's decision to either approve or decline your loan request. Generally, the higher your credit score, the more likely you are to get loan approval. The lower your score, the more difficulty you will face getting loan approval. If approved, your score will impact the amount of interest that you will pay. Lower credit scores are generally charged higher interest. Higher credit scores generally have lower interest rates. What drives your credit score? Understanding the FICO model will help you better understand how credit works. The FICO model is a summary of your credit report and measures several factors. 90% of the nation's top lenders use the FICO score to determine your creditworthiness. 35% of your FICO score is based on your payment history. This is the largest and most important factor of the score. The first thing lenders want to know is if you pay your credit accounts on time. Are you late every month, or do your payments arrive on time? The history of your credit payments is the strongest predictor of whether you will pay your debts as agreed. Paying your payments on or before the due date is very important to establishing a strong FICO score. 30% of your FICO score is amounts owed, which reflects how much debt you carry in total. Overextending your credit could indicate poor money management. Keeping your overall balances low will have a positive impact on your score. 15% of your FICO score comes from length of credit history. The longer your credit history, the stronger your score. This percentage considers how long your credit accounts have been opened and how long it's been since these accounts have been used. These factors are important when deciding whether to close an old credit card. Closing an older line of credit could have a negative impact on your overall score because you've decreased your credit history. 10% of your FICO score is credit mix. This includes credit cards, retail accounts, installment loans like your car, mortgages, and finance company loans like cash advances. Having a strong mix of loans could improve your overall rating, and having a solid payment history within that credit mix proves to lenders that you can properly manage different loans and lines of credit. The final 10% of your FICO score is new credit. Opening several new credit accounts within a short period of time could represent a higher credit risk, therefore decreasing your overall FICO. Here are 5 tips to boost your credit score, improve your credit, and achieve an exceptional credit score so you can accomplish your financial goals. Number 1, pay all your bills on time. Paying on time will ensure an unblemished payment history, keeping your scores in good standing. Paying on time also proves to lenders that you are timely when it comes to paying back what was borrowed. Number 2, keep balances on your credit lines low and keep your utilization at a good limit. Credit utilization is how much overall debt you owe compared to how much credit you have available. For example, if you have $10,000 in available credit on a credit card or a line of credit, and you have used $4,000, you have 40% utilization. It is commonly recommended not to exceed 30% utilization. Keeping your utilization under 30% signals to lenders that you know how to properly manage money. Anything over 30% could be a red flag to lenders. Number 3, limit applications for new credit to only when you need it. Each time you apply for new credit, your score takes a hit, which could result in a decrease in your credit score. Don't provide your Social Security number to lenders while shopping around, but only when you're ready to borrow. Monitor your credit report and score to identify any errors. If errors are found, dispute them quickly and make certain your error is completely removed from your report. www.annualcreditreport.com is a great source that provides access to all 3 credit bureaus and allows you to pull a detailed report with each. Take advantage of other services provided by some credit monitoring services, such as notifying you if your identity has appeared on the dark web, accounts where you have used the same username and/or password, and more. Number 5, mix it up and keep your lines open. Having a healthy mix of installment loans, like auto loans, and revolving credit lines, like credit cards, could boost your creditworthiness. Closing old credit card accounts could lower your score. When you close a line of credit, you are decreasing your overall credit history. Old accounts prove credit maturity. Another key component to managing your overall financial health is developing and following a budget. A budget is a financial plan that allocates future personal income towards expenses, savings, and debt repayment. Budgeting takes communication and accountability. When you take the time to identify and track your income and expenses, you're taking the biggest and most important step to financial wellness. When you have a manageable budget, you're able to achieve your savings goals. You become less stressed, more productive, and increase your overall happiness and quality of life. Sticking to a budget can provide opportunities to expand your financial security through investments. Investing requires saving money to invest, then developing a diversified portfolio. Portfolios need to be adjusted periodically based on life changes, but the focus should remain on the long term. Financial institutions have various tools for budgeting and investing. For more information, check out the budgeting and investing modules in this series.
Congratulations, you've completed the Banking Matters module for the Financial Literacy Project. Knowledge is power, so be sure to share this module with your friends, family, or anyone else in the community who might benefit from it. Empowering ourselves changes our lives, but empowering others changes our communities.